You can't really go out there and say like, I'm gonna sell the company. Companies are being bought; they're not being really sold. So the premise, of course, is there are companies out there who are looking for a startup to buy. Usually, you don't really convince someone to buy your company. Like they're usually looking for something, and then you happen to meet, basically.
Hello, I'm Brian Rios, marketing specialist here with Wahl+Case. Today, I'm excited to be with Fuminori Gunji, previous Chief Operating Officer from MakeLeaps,
Right.
Soon to be Blue Circle.
Right.
Do you want to talk a little bit maybe about Blue
Yeah.
Circle, what
Sure,
the idea
definitely.
is there?
Well, first of all, thanks for having me. I'm very looking forward to this interview, and it's going to be fun. So what is Blue Circle? This is a company that I'm gonna starting with a friend of mine that I worked together back when I was working at Softbank. And what we do is basically a very early stage startup consulting advisory. And what we recognized is there are a lot of VCs out there, and the sort of whole startup environment in Japan has improved a lot over the past few years. But there's sort of a gap between the people who need advice can't really afford the kind of advice that they would like to have, which is usually like very early stage startup before even the first round of funding or seed funding. And so what we do is basically based on our expertise. My friend of mine has experienced a lot of fundraising rounds himself as a former CFO of a startup. And so what we do is we just are sort of mentoring partners, but also like discussion partners, and also like giving advice on how to get your story right in getting you to fundraising, and also how to communicate to investors, for example. That's what we do. Yeah.
That's great, that's great. And I think that what we've talked about before too is you specifically have a very unique perspective in order to give that advice. And that comes from being on both the buyer side with Softbank Robotics for 4.5 years, and then with MakeLeaps, helping them through that process now with Ricoh.
Right.
Do you want to touch maybe a little bit on just how you gained that perspective, things that kind of led you to
so
this?
it's not planned at all. It's just a bunch of coincidence, basically. When I was working at Softbank, I was working for a department called New Business Development. And that was a department that was sort of directly under the reporting line of Masayoshi Son. And so Softbank was basically seeing the mobile service business as something that's it's a cash cow, but it's not something that necessarily grows exponentially in the future. And so the mission of that department was how can we build the new, or how can we find the new kind of sort of key business or main business for Softbank that will be the main revenue driver for the next 30 years, that kind of stuff. So very like grand mission. But what we basically did was we tried out a lot of different kinds of business ideas, like really ranging from like green tech to, I don't know, gaming, and eventually one of them was robotics, for example. But in that process of testing these ideas or exploring certain sort of ventures, Softbank, now everybody knows, is buying a lot of companies, of course. So I was usually on the buying side, not in terms of like doing the financial deals. I was not in that Softbank Vision Fund or anything, but I was sort of on the business development team that would then work together with some of these startups. And so that gave me a lot of good understanding of what Softbank expected from these companies that they acquired. And sort of the power dynamics and sort of the discussions that were going on within Softbank when evaluating the acquired firm, depending on their performance, for example. So I have a very good perspective on like really the internal feelings of people who buy a company and what they want from it. And then when I joined MakeLeaps, we did some fundraising, and we just basically were looking for just different kind of VCs again. But then not really unexpectedly, I can sort of elaborate on that a bit later, but we ended up doing an M&A with Ricoh, and so then I suddenly was on the sort of selling side. And that sort of was the experience at Softbank was really helpful, because I understood how Ricoh probably thinks about us and what they're expecting from us and how they want us to behave and how they want us to communicate with them. And I think that was very helpful in making the sort of post-merger phase really work well. And we still have great relationship. I just had lunch with the current sort of CEO of MakeLeaps just yesterday, actually. And it's yeah, we always maintain a very sort of friendly, honest, and frank communication relationship, and it's going well. So yeah, that's sort of the perspectives to both sides that I have right now.
That's awesome. And kind of continuing on that, I think there are three main perspectives that you wanted to go through today,
Right.
And each one kind of covering one phase of an M&A. And the first one would be like when does it make sense,
Right.
and then how to find it.
Right.
And then the second one is kind of evaluating the buyer, knowing when you have a good buyer.
Right.
And then the final would be that transitionary period after post M&A. And so I guess let's start with the first phase.
Yeah.
And so when does it make sense, and
Right.
how do you find a buyer?
Right. So yeah, before going to that one thing to mention is, of course, you can't really go out there and say like, I'm gonna sell the company. Companies are being bought; they're not being really sold. So the premise, of course, is there are companies out there who are looking for a startup to buy. Usually, you don't really convince someone to buy your company. Like they're usually looking for something, and then you happen to meet, basically. So what you need to do is you can't really sort of, companies are being bought and not sold, but at the same time, of course, you need to make yourself visible to the potential buyers. So that's sort of the story there. But yeah, when does it make sense? So usually you don't really start out with saying, okay, let's do an M&A. It's more like, okay, there's another, there's a certain burn rate and your runway, you see the end of your runway and you say, okay, it's time to do fundraising again. And the M&A is just one of many options you can do, alternative to just raising another fund from whoever VC, for example. And but of course you have to be open to getting fundraising from CVC, for example. So this is just not speaking specifically about any case, but including the ones that I experienced at SoftBank. And usually also the buying company, which is usually a big corporation, of course, most of the time they don't go out and say, okay, let's go buy a company. It's mostly the case that they say, okay, let's invest in some startups. And so these companies, the big corporations that want to invest in startups, they usually call like CVC or corporate venture capital. And there's usually a team of, these finance department people, or maybe they have brought in from someone else with, more expertise in the startup environment. And then they say, okay, we want to enhance our business portfolio, and we know that our own new business development department is not as strong, or we don't have the right kind of people to build a new business. So why don't we just acquire one, or sort of invest in a company? And basically, by investing into a startup, they can basically say, okay, now we have a bit closer relationship than all the other potential business partnerships. So you kind of try to buddy up with the startup and say, we sort of have an exclusive deal or something, that kind of stuff, right? So, and usually they just invest, usually a minority stake or even a majority stake, so meaning more than 50%. And by doing so, they kind of get a lot of information from that startup. Because if you are an investor, you get to see all the sort of financial materials and how the company is actually performing. You get to have a seat in the board meeting, for example. So you get to have a lot of information and insight about if that company actually is, working, and if they're actually going to be successful. So you get a lot of information basically, and can sort of assess, whether it's worth to buy, for example.
It's like a pre-buy kind of risk management.
Exactly. Right. So usually you start with that one. And then when you gain confidence, this is definitely a good company, and it's a great product, the customers are happy, and that kind of stuff. Then they say, okay, let's buy. So usually you go through these steps until you actually buy a company.
Would you say that at that point, like both parties are pretty much aware of what's happening, or does it seem more just like a casual kind of like preliminary investment, or?
Depends. In both cases, sometimes you sort of say very much from the beginning, as from a big corp perspective, like, okay, we want to expand in this business domain, but we don't really we want to get a foothold there, and we think you're great, and eventually we could think about an M&A, for example, as well.
Yeah, for sure.
Sometimes you do that discussion, or sometimes it's just, okay, I like your business, I like your product, and we think the other businesses that we have can sort of contribute a lot to making it grow. So let's sort of have a more deeper partnership, and let's start from there, and let's see where it goes, kind of thing. Yeah, so there's like different types. Yeah.
Nice, cool. And so, so you're kind of at the point where you see the outcome, and so what would you say maybe are the best strategies to go about actually finding an M&A? I know you said that it's really, most companies are bought and not sold.
Right.
If you are interested, how do you make yourself, I guess, appealing to a buyer?
Right.
Or how do you market it?
So one thing when it comes to these corporate venture capital people is they are not so much out there in the startup environment in general. Like you get to see and get to know VCs fairly easily, I would say, or relatively easily when you're working in startup environment, because they, show up at events and exchange business cards and that kind of stuff. So they're very close to the startup environment. But CVC people are, let's say, they wear usually ties. Let's put it that way. They don't really show up in these events, and let's say they're not necessarily the coolest guys, for example. I hope that you can cut that out. No, it's fine. It's fine. But anyways, it's just a different vibe. It's a different vibe.
I know what you mean. Yeah.
So what you usually do is if you are sort of considering that step as well, or even if you're just doing fundraising, via VCs, that's still applicable. Is you kind of find a company that does a financial advisory service. There are companies like a lot of them, Deloitte, KPMG, that kind of stuff. They usually have a section that help companies find the people who want to invest in the company. And they have a huge list of all the sort of big corporations that have a sort of investment unit in them. And they usually have some connection with these. And having someone sort of in between helps you to, basically they can sort of vet the whole list of potential investors while still keeping your company name anonymous, for example. So together with these companies, you can sort of work on a pitch deck, and then they send it out on your behalf, but from their email account, basically. So nobody knows what is happening. That's good if you want to keep a certain kind of distance. Yeah, right. You don't want to make everything public right away. So having someone in between helps. So it's it's very good to, unless you already know a lot of VCs, for example, it's very good to contact some of those M&A advisory companies and say, can you help us out? And the way the deal usually works is they take a certain percentage cut of whatever the deal size is.
Cool.
And it's very important and they basically act like a project manager for that fundraising or that M&A, for example. And that's very important because you are doing your own job, which is usually busy enough, right? And the very fact that you're doing fundraising means that you kind of see the end of your cash, right? So you also getting a bit nervous and stuff. And when you do that kind of deal, there's a lot of technical details, and sort of you have to answer a lot of questions, and they do a lot of, the buyer side will ask a lot of due diligence questions, and sometimes you need a translator to understand what is this asking. Like there's some certain terms you're like, unless you're really in finance industry, like you're like, I don't know. And of course there's an answer, but somehow you need someone to translate what that actually means. And there's also like a lot of paperwork and sort of technical steps. And basically it's good to have this sort of secretary, project manager for that thing, so that they sort of, they keep the pace and say, hey, we need to answer this email. Because a lot of emails coming in, so it's good to have sort of a pacemaker and someone who has the expertise for making these deals kind of happen. So it's good to interview a lot of these companies and pick the one that you like best. Also in terms of what their cut rate is, in terms of depending on the deal size. Of course, they don't do all the kinds of deals. Like for every deal size, there's a different kind of player. Let's say. So you need to sort of get familiar with some of those companies, interview like 5, 6, 7 of them, and then sort of figure out which one works for you. And of course, you have to work with them very closely over, these deals can take like 6 months or longer, right? So it's also important, like whether you have good chemistry with them, like can you communicate with them really quickly, and do they get you, and that kind of stuff. So yeah,
that's it's interesting because I think you're right. It's like a big commitment. Like it seems like it could go pretty quickly, but I've heard it can take up to like 9 months even, and it's
easily.
like a long process.
Yeah.
And so once you kind of have vetted maybe the bigger groups of buyers, how do you know? What are the terms, I guess, that you would evaluate? Like, how do you find like a good buyer?
Right. So. So speaking in terms of like in the context of M&As, it's very important to see when you get to know a potential buyer, like someone who's showing interest, is to really look into, first of all, their business portfolio and really ask a question, okay, why are they interested in buying us? What are the potential synergies with their existing business? And are they already doing something in this moving towards this business domain that you're having. And the reason is, at the end of the day, it's always about synergy, right? It's always about how do you fit in with the other business portfolios, how can they be helpful to you? Speaking more concretely, for example, what kind of customers do they have with their current businesses? Are these the type of customers that you would want to have as well? That kind of stuff. Is there a lot of potential for mutual customer referral, that kind of stuff, or do they have sort of neighboring solutions or services that would be great to integrate with yours? That kind of stuff. And the other thing is. This thing that I mentioned before is, are they already taking some steps in that direction? Because sometimes there are people in a big corporation. There's a lot of politics going on, of course, and it might be the case that there's just one executive who wants to, I don't know, prove himself or build up a case to promote himself, but it's not really backed up by, let's say, the whole overall corporate strategy, for example. So you want to check: is this interest something from a few individuals who just find this startup or your startup very interesting, just out of more like personal interest, or is there a sort of bigger dynamic going on that they want to move to digital, or that they want to move to whatever your business domain is? And because if it's not there, that means it's probably harder to get your budget basically after the acquisition. Because the thing is, after you get acquired, you basically become sort of a business department of that company, and then it's the way you get the funding is very different than when you're a startup, because it's about, okay, the big corporations have budgets, and then you have to say, okay, how do I fight for the budget, and how do I justify that your business line or your business department is worthy of that budget? And so you basically compete with all kinds of other business departments for the budget, right?
100% no. So before I worked at Wahl+Case, I was with a company called Honest Tea. It was a brand in the Coca-Cola venture portfolio. And I joined about 6 months after Coke had fully acquired Honest Tea, and just the amount of red tape that comes up after that, and the processes, everything just gets really slow, and we really had to fight for that budget versus Fanta, which is a huge brand or something compared to our tiny new acquisition. So I totally understand.
Yeah, so this whole budgeting process is something that takes 3-4 months for every fiscal year, and so. If you want to grow and sort of be nurtured after the acquisition, which is obviously the case, then you want to have a lot of people in that big corporation, regardless of which department or sort of which layer of positions, that there are a lot of people who agree in general that they say, okay, this is our company strategy. We want to grow in this business domain, so of course we should spend budget, whatever is related to that business domain, which includes your company, for example. So that's why, and because the risk, of course, is if it's sort of dependent on some individuals, obviously when they're doing something like trying to acquire a company, then they're taking a risk, right? So if they somehow lose the political standing or whatever, and they get fired, then basically you are also kind of fired, or you basically, you won't get the budget, and they let you dry out. That's sort of the risk that happens. So again, the whole important thing is you look at the buyer company's business portfolio, you look at past investor relationship materials, and sort of look and try to find keywords, whether they're sort of promising investors that they want to move into that domain.
Yeah.
When you see those keywords that sort of, are very much sort of aligned with what you do, then it kind of makes sense, like, okay, they're serious about this, they really want to move in this domain, so it makes sense for them, not just for certain individuals. So that's like something to look for.
That's great. Yeah, totally. That definitely makes sense. Again, like kind of talking about when I was at Honest Tea, like a lot of what we talked about was kind of like the market trends and how organic was going to come up, and that was really what we were looking for in like this lifetime kind of portfolio of what our customers look like. And Coke was very interested in getting into that space, and so we were like the first kind of move into that.
Right.
And so I think it made a lot of sense at the time, and I think Coke's made they put a lot of budget behind Honest Tea at the time, and so it was really great. And so it's funny to hear you talk about these things now, and I'm reflecting on that previously. Okay, so we kind of know how to find a good buyer. We've gone over the first phase. So the third phase then is like post M&A. Like you outlined a little bit about like maybe how it can go poorly, but maybe if you could expand a little bit on things to keep in mind in that area and how to make that transition really gel.
Having the audience in mind too, I think maybe many of them work in startups, is it's just really fundamentally different than raising a fund from a VC. Like if you do M&A, you sell the company and you're not the owner of the company anymore. So that's something you really have to sort of carve into your brain and sort of realize, or accept the new reality that they are the business owners. And what that means is, if they are the business owner, it means they own all the future earnings that comes from your business, right? And it is their responsibility at the end of the day. It's also their responsibility to make it grow. And your job, if they want you to stay in, which is even it's not a hostile takeover, it's always sort of honest discussion that you should have. If they want you to stay in, then you have to know that means you basically become sort of a middle manager, right? Usually then you build a new sort of board of directors, and of course they have the majority vote in that board of directors, and basically you report to them about your monthly KPI, basically like sales, revenue, cost, that kind of stuff. And there are sort of very different kinds of freedom you get that really depends on the deal. Sometimes companies say, we just give you a budget and we let you do whatever you think is the best use of the budget. Like we don't tell you how much budget to use for HR or that kind of stuff, like it's up to you. Other cases are a bit more stricter in terms of, we give you, they're a bit more controlling, basically like, okay, these are the rules of how you spend the budget and that kind of stuff. And above this amount, you have to get a board of directors approval and that kind of stuff. So that's really like case by case, and I can't really say generally speak about that one. But the point is, becoming a middle manager means you have to communicate a lot about what you're doing and have a responsibility to report about it, because they of course made fairly expensive purchase in a way, and they want to know what's going on. It's their right to know what's going on. Like you have to understand there was someone who put a lot of money, maybe some risk, and had to convince some people within their company. And so now they want to know, is it going well? Can I help you? And of course they want to help you, right? So it's really important to understand, okay, it's not me who's the owner of the business, so you can't do whatever you want. You have to keep in mind that in a way they are the very first customers. They're the new customers other than your actual end customers. That's another customer, a very important other customer. And it's probably best to treat them like a customer with whom you share a lot of information, like internal information as well. But at the end of the day, it's sort of like customer relationship as well, customer partner relationship. And so yeah, that's I need to repeat this one because it's really, it takes some time to let it sink in, because when you're used to sort of building the business and you owned everything and you made the decisions without necessarily having to ask someone, now suddenly it's a very different environment. So that is a huge shift, and you really you need to carve into your brain. You don't own the business anymore; they own it, which is good and bad, because at the end of the day, if things fail, that's also not your responsibility. Like it is, of course it is, but it's also theirs, right? There's always someone that they need to report to as well. They need to report to the internal board of directors, to their CEO, whatever, and say, hey, you pushed for buying this company, and something's failing, so it's kind of up on you, right? And then, so you have to sort of have a lot of understanding for the people who are sitting across the table, because whatever questions they're asking you, they're probably being asked the same questions from their bosses, right? So they are also, in a way, middle managers most of the time, in a and not in a classical sense. They're also like directors or whatever, but there's someone that they need to report to as well, and they're asking these questions because of that one. So you need to understand, let's help each other out to how can I make your job easier so that you can report nice things to the top, and how can you help me so that I get the job done, so that we get to report nice results, right? So it's really important to have this very friendly relationship, build a really friendly relationship with them, and just be honest about even the shitty things that happen in the company sometimes. Sometimes it's embarrassing, you don't want to share everything. And previously you might not have, it wasn't maybe necessary to share it with everything. I mean, you can hide things from employees, and then VCs, they don't really inquire that much. But in an M&A environment, it's probably good, when you think this might become a problem later on, a bigger one, it's probably better to just, give them signals like, hey, this might come up. Maybe we can fix this, but I just want you to let you know there's something happening here, and we might have to think about a counterintuitive counteraction, or that also happens quite a lot, and it's sometimes I think harder to ask. Understand that you can ask this question is basically, I think we need more budget. Like it's not a no-go, right? It's not a no-go. You can ask these questions because sometimes they might have some extra budget somewhere, and then they say, well, in that case, even though we agreed, that we agreed on these KPIs for this budget, what you mentioned, makes a lot of sense. So there has been change in the market dynamics or development. So let's get some more additional budget from that other department that doesn't need it so much and get it on you. They can do these kind of things. Course correct. So even though you're being asked to commit to the business plan, and it may sound like something that's sort of carved in stone, at the same time it's also not. So basically that shouldn't be, just because you agreed to something doesn't mean you can't ask them for help if you think that's not realistic anymore. So that's really important, to have this very candid relationship, and go out, do drinks with them and that kind of stuff. And just one more thing, they bought you, so you kind of maybe, leading up to the M&A, unless it's a hostile takeover, of course you want to make things work, so both parties are very, very friendly to each other, right? And sometimes it can become difficult to sort of bring up difficult questions or sort of things that might sort of, let's say, bring tension to that relationship. Because you just started dating in a way, right? And you don't want to, bring up something that's don't want to talk about, but that's something you just have to jump over and just, go straight to sort of very honest communication, because then they will open up more as well. And the people that you usually deal with are very, very busy people. Like they usually have another line of business that they have to take care of, and then your business is always something that they have to do in addition. So don't wait for them to invite you to drinks or dinners or meetings, other than the monthly board director meetings or whatever. It's kind of your job to build the relationship. It's kind of your job to build rapport with them, and so be proactive in asking them out for dinner, or asking for another kind of meeting. And of course they'll be busy, but don't be intimidated by that. You are the one who should be proactive in building up the relationship, and then things will usually work out fine.